Join our family of creators. Your support means the world to us. Subscribe now to the Content Creator channel. Your support keeps us motivated and helps us bring you fresh, exciting content every week. Hit that subscribe button and be part of our journey. Good evening. Let's talk about the economy. Specifically, the economy under one Donald J. Trump, a man who treats economic policy like a toddler treats a coloring book. With lots of enthusiasm, very little regard for the lines, and a finished product that is somehow both chaotic and surprisingly popular with a certain demographic. As of today, September 8, 2025, we have a fascinating new piece of data that should make your brain do a little somersault. Despite years of economists screaming into the void about impending doom, the latest figures show that consumer spending in lower-income households has hit a 5-year high, even as national debt has ballooned to a size that would make a blue whale look like a goldfish. It's a baffling contradiction. It is the economic equivalent of a man surviving a fall from a skyscraper by landing in a conveniently placed pile of money, only to realize the money is all counterfeit. This isn't just a number on a spreadsheet, it's a symptom of a much larger, much stranger phenomenon. We were promised a return to American greatness, a tidal wave of prosperity that would lift all boats. Instead, we got something far more complicated. The economy became a high-stakes game of Jenga, where blocks were being pulled from the bottom to build a glittering, unstable tower at the top. So tonight, let's do just that. Let's turn on the harsh, unforgiving fluorescent lights and examine this economic beast. We'll look at the promises made, the policies enacted, and the cold, hard data that tells us what actually happened. Let's get into it. At the heart of the Trump economic philosophy, if one can call it that, was a single monumental piece of legislation, the Tax Cuts and Jobs Act of 2017. This was the big one, the main event. It was sold to the American public as rocket fuel for the economy, a revolutionary idea that involved giving a massive tax break to corporations and the wealthiest Americans. The corporate tax rate was slashed from a hefty 35% all the way down to 21%. The thinking, or at least the sales pitch, was simple. If you give companies a giant pile of money, they will gratefully turn around and invest it in new factories, higher wages, and more jobs for everyone. It's the classic trickle-down theory, an idea so beloved by conservatives that they keep trying it, hoping it will one day work. The promise was intoxicating. Proponents painted a picture of a newly unleashed American industry, where companies freed from the shackles of high taxes would bring jobs flooding back from overseas. Donald Trump himself claimed it would be like a shot of adrenaline to the economy's heart, leading to an average household income increase of at least $4,000. It was a beautiful story, full of optimism and patriotic fervor, the kind of story you tell your kids at night, if your kids are really into corporate tax law. The problem with beautiful stories, however, is that they often have a shaky relationship with reality. Well, it turns out that when you give a dragon a pile of gold, it doesn't usually open a community center. A vast majority of the money from the tax cuts went directly into stock buybacks and increased dividends for shareholders. In 2018 alone, corporations announced over $1 trillion in stock buybacks, a record-breaking figure. And then, there were the tariffs. Oh, the tariffs. If the tax cuts were the main course of Trump's economic banquet, the tariffs were the weird, spicy side dish that no one was sure how to eat. Trump, a self-proclaimed tariff man, he believed America was being ripped off, particularly by China. His solution, slap massive taxes on imported goods. The idea, make foreign products more expensive, encourage American consumers to buy American-made goods, and magically resurrect American manufacturing. He famously declared, "Trade wars are good and easy to win. Historical hubris, this ship is unsinkable." The reality was far messier. A tariff isn't a bill you send to another country, it's a tax paid by American importing companies. That cost is almost always passed to American consumers. Trump imposed tariffs on steel aluminum washing machines, solar panels. It wasn't China footing the bill, it was you. Anyone buying a car, a can of soup, or a new appliance? NBER studies, consumers and businesses bore virtually the entire cost. The fallout was immediate and widespread. Other countries retaliated with their own tariffs. This hit American farmers particularly hard. China closed off markets for soybeans, pork. The result? Crisis in the heartland. Farm bankruptcies surged. Government had to roll out a multi-billion-dollar bailout, like punching a friend, then handing them an ice pack metaphor. The promised manufacturing renaissance never materialized. It was a self-inflicted wound that created chaos in supply chains, raised prices for consumers, and alienated our closest allies. Another cornerstone of the Trump agenda was deregulation, a word that sounds responsible and boring but is actually incredibly dramatic. The administration embarked on a mission to slash federal regulations with the fervor of a teenager cleaning their room by shoving everything under the bed. The guiding principle was that rules, governing everything from environmental protection, financial practices, worker safety, were strangling American businesses in red tape. The promise was that by cutting these rules, companies would be free to innovate, expand, create jobs without the heavy hand of government holding them back. Trump boasted that for every new regulation added, his administration would eliminate two, a catchy but frankly terrifying metric for governance. This bonfire of the regulations had some predictable and immediate effects. For certain industries, it was a dream come true. Oil companies celebrated the rollback of Obama-era emission standards, gas companies celebrated the rollback, coal companies celebrated the rollback, which made it easier and cheaper to extract and burn fossil fuels. The financial sector cheered the weakening of Dodd-Frank rules, which were put in place after the 2008 financial crisis to prevent another catastrophic meltdown. On paper, this looked like a win for business. Corporate profits in these sectors saw a noticeable uptick, and executives praised the new business-friendly environment. But here's the thing about regulations. They're not just there to annoy CEOs. They're there to stop rivers from catching on fire, to prevent banks from gambling with your life savings, and to ensure you don't get your arm caught in a meat grinder at work. The hidden costs of this deregulation spree are only now, in 2025, becoming fully apparent. We've seen a documented increase in industrial pollution in communities near deregulated facilities. The weakening of endangered species protections has pushed more animals toward extinction. Jobs, jobs, jobs. That was the relentless mantra of the Trump presidency. And if you look at the top-line numbers, it seems like a promise that was delivered. The unemployment rate was already on a downward trend before 2017, continued to fall, reaching a 50-year low before the pandemic threw a wrench in everything. The administration celebrated these figures as undeniable proof of their success. Every month, the jobs report was brandished like a trophy, showcasing an economy that was supposedly the strongest in the history of the world. For many, this was the only metric that mattered. If people were working, the economy was working. But the headline unemployment rate tells a very incomplete story. It's kind of like judging a movie by its poster. You need to look closer. When you dig into the data, a more complex picture emerges. Show unemployment versus wage growth. For instance, much of the job growth was concentrated in low-wage sectors like hospitality and retail. These are jobs, yes, but they are often part-time, with unpredictable hours and few, if any, benefits. So while more people may have been employed, many were stuck in a cycle of precarious work, juggling multiple jobs just to make ends meet. The labor force participation rate, which measures the share of the population that is either working or looking for work, remained stubbornly below its pre-2008 crisis levels, suggesting many people had simply given up. Furthermore, the promise of a manufacturing renaissance, a core justification for the trade wars, never truly came to pass. While there wasn't a total collapse, the manufacturing sector saw only modest growth in line with earlier trends. This creates a tale of two realities. For someone with a 401k and a stable white-collar job, the economy probably looked fantastic. But for a former factory worker now working 2 part-time gigs at a fast food restaurant. As one laid-off steelworker from Ohio, David Chen, told a local paper, "They say unemployment is low, but I went from 1 good job with a pension to 2 bad jobs with nothing." Remember that promise of a $4,000 raise for the average American family? Let's check in on that, shall we? The issue of wages is where the greatest economy ever narrative really starts to fray at the edges. While jobs were being created, the growth in what those jobs actually paid was, to put it mildly, underwhelming. For years, wage growth remained stubbornly sluggish, barely keeping pace with inflation. This means that for many working families, their paychecks got bigger, but so did the cost of everything else. Paychecks got bigger: gas, groceries, rent, healthcare. The net result was that they were essentially running in place, working harder just to maintain the same standard of living. The data from the Bureau of Labor Statistics tells a clear story. While there were periods where wage growth ticked up, particularly for the lowest paid workers, the overall trend was not the explosion of prosperity we were promised. Real average hourly earnings, which account for inflation, showed only modest gains. This disconnect between a supposedly booming economy and stagnant paychecks was a source of deep frustration for millions. It felt like being invited to a massive party but being told you could only have a glass of water and a single slightly stale cracker. The celebration was happening, but a lot of people weren't really part of it. Experts point to several reasons for this wage stagnation: decline of unions, rise of the gig economy, concentration of job growth in low-wage sectors. The Trump administration's policies did little to reverse these long-term trends. The corporate tax cut, which was supposed to trickle down in the form of higher wages, largely ended up in the pockets of shareholders. It was a massive transfer of wealth upwards, not downwards. As economist Dr. Isabella Rossi notes, the link between corporate profits and worker wages has been broken for decades. The 2017 tax cut was gasoline on that fire. So, are we rich yet? For the vast majority of Americans, the answer is a resounding no. The feeling of being left behind, which was a powerful force in the 2016 election, was not resolved by Trump's economic policies. In many ways, it was intensified. If you wanted to find the glittering jewel in the crown of the Trump economy, you needed to look no further than the stock market. The Dow Jones, the S&P 500, the Nasdaq, they all went on a spectacular bull run for much of his presidency. Records were not just broken, they were shattered. For the administration, this was the ultimate report card, a daily affirmation of their success broadcast on every news channel. The soaring market was presented as proof that their policies of tax cuts and deregulation were working, unleashing a wave of animal spirits and business confidence. And for the roughly 55% of Americans who own stock, either directly or through retirement accounts, it certainly felt like winning. But the stock market is not the economy. It is a very important distinction that often gets lost in the celebratory headlines. The stock market reflects the profitability and perceived future value of a select group of large, publicly traded companies. It does not reflect the financial health of the average family, the stability of small businesses, or the overall well-being of the nation. Relying on the stock market as your sole economic indicator is like judging a person's health based only on how stylish their haircut is. It might look good, but it tells you nothing about their blood pressure or cholesterol levels. And speaking of blood pressure, let's talk about the national debt. While the stock market was reaching for the stars, the national debt was digging its way to the Earth's core. The 2017 tax cuts, which were not paid for, blew a massive hole in the federal budget. The Congressional Budget Office estimated that the law would add trillions to the national debt over a decade. And it did. During the Trump presidency, the national debt increased by over $8 trillion. This happened during a period of economic expansion, a time when a fiscally responsible government would typically be trying to pay down its debts, not run up the credit card. So while investors were celebrating, a giant bill was being handed to our children and grandchildren. So, after all that, what is the shocking truth about the Trump economy? It's this. It wasn't really an economy built for long-term prosperity, it was an economy built for television. It prioritized metrics that look good on a screen. A booming stock market, a low headline unemployment rate while ignoring the rot forming underneath. The foundation was weakened by staggering debt, the support beams were chipped away by deregulation, and the benefits were largely hoarded on the top floor. It was a sugar high, not a healthy meal. And now, in 2025, we are dealing with the inevitable crash that follows. The party is over, and we're left with a massive cleanup job. The core lesson from these policies is that short-term gains often come with long-term pains. The tax cuts delivered a quick boost to corporate profits and stock prices, but they did so at the cost of trillions in national debt and exacerbated inequality. The trade wars were a simplistic solution to a complex problem that ended up hurting the very people they were supposed to help. And the deregulation drive may have cut costs for some businesses in the short run, but it has passed on much larger costs, in the form of environmental damage and financial risk, to the rest of society, to be paid at a later date. So what should you, an ordinary person, take away from all of this? First, be skeptical of simple answers to complex economic problems. If a politician promises they can fix everything with one big tax cut or a trade war, they are either lying or dangerously incompetent. Second, understand that the stock market is not your friend. It is not a reliable indicator of your financial well-being. Look at your wages, your job security, and the cost of living. That is your personal economy, and it's the one that truly matters. Ultimately, the story of the Trump economy is a cautionary tale. It's a reminder that economic policy has real-world consequences that extend far beyond a cable news chyron. It shows us that an economy that only works for the wealthy is not a strong economy. It's a fragile one.